Well, so today our topic to discuss is financial markets and the economy. This topic is related to the markets which are considered as a financial market. So in this topic, we're going to talk about three different markets: market for bonds, and then we will talk about foreign exchange market, and third thing we talk about is money market. So let's start with this topic. So what are the learning outcomes from this topic is that after this you will be able to understand the bond market. What is bond? So bond is an instrument of a debt through which the bond issuers getting money to finance the projects, and the investor in the bonds are those who are investing in the that bond and get some returns on it. So that's a investor is the lender, and the issuer is the borrower. So by this way it works. Then you will be able to explain and illustrate how the bond market works and discuss the relationship between the price of the bonds and the bonds interest rate. So we will see the relationship in detail when we are talking about bond market. In the second part of this topic, we're going to talk about foreign exchange market, where we try to explain foreign exchange markets, how they change in the demand for a country's currency or a change in its supply affect the macroeconomic activity, like a real GDP or the real output. How is going to change when the currency appreciate or depreciate. So this is the second thing what we're going to talk. In the third part of this video, we're going to talk about the supply and demand in the money market, and how the supply and demand determines the interest rate in the economy. So the motives for holding money, that's the why we keep why we demand for money. And then we will see that the central bank of a country, like a Bank of Canada, controls the money supply and how they manage it. And by this way, we see that when the money supply increase, what is the impact on it, on the interest rate, and when the interest rate change, what is the impact of that change in interest rate on the real GDP output. So by this way, we're going to talk about the relationship of these three markets with the real macroeconomic activities or a real GDP in the economy. So when we talk about financial markets overview, so financial markets connect savers and borrowers. So as I mentioned, that the objective of the financial market is to work as an intermediary between the saver or the lender and the those who are in need of funds, like a borrower. So this is the way that it's connected. So it's a medium through which the borrower and saver and borrowers interact. So that's all mechanism is considered as a financial market. So two markets: bond market and exchange market. And the third, how they influence the investment, trade, output, and employment. So that's going to be, we talk about it, and the money market also. Now we focus in this part only in the bond market. So in pursuit of new projects, institutions such as firms and governments often borrow. Now, whenever they have a big project and they want to start some new facilities for their businesses, or the government wants to construct a new dam or a new motorway or a new LNG terminal. So they want to generate funds. Now, these high value projects needs a billions of dollars, and the financial institutions are not in a position to lend a single borrower or a consortium of borrowers, few borrowers, such a big amount of money, because that creates a risk for them. Although they can borrow money from the banks, but in that case they prefer to borrow the money from the public. And the way that they can borrow from the public is that they sell them the bonds. So many institutions, however, obtain credit by selling bonds. The federal government is one institution that issue bonds. The federal government is issuing bonds throughout throughout the term they are in power and the next government is gone. But their way of issuing a bond is like they sell the bonds to the Bank of Canada, and then Bank of Canada sell these bonds to the commercial banks, and commercial banks ultimately sell these bonds to the public. So by this way, there is a continuous process going on of selling. And well, the short-term government bonds are called as a very specific name, and they are called as T-bills. Firms often sell bonds. The corporations also, like here in case of a Canadian economy, we see that Thales, Roger, these are the big corporations. They are issuing bonds to generate funding for their big projects. So firms often sell bonds to finance expansions like this. As we mentioned, that there is a way that they can get finance to do some big projects. The market for bonds is enormously important one. So from this perspective, the market is required in an economy for bond, that there is a very active market for buying and selling of bonds. So by this way, the investor is feeling confident that they can sell their bonds anytime, and the issuers of the bonds also find it convenient that there is a secondary market, or there is a market available in which the people are buying and selling bonds. So if the market is more active in an economy, so this is a easy way of generating funding for big projects. So that's also one of the reflection that the financial market is strong in the country, and financial markets help in the economic growth of any country. When an institution sells a bonds, it obtains the price paid for the bond as a kind of a loan. So issuing institutions sell the bond. So what they sell a contract or an agreement that we will pay you back this amount, and during this period we will pay this much interest on this amount. So that's an agreement. They sell it. In olden days, that's a paper-based certificate. We call it as a bond certificate. Nowadays, it's a digital. So the borrower sell these to the investors, and investors buy these contracts or agreement in return of the money. So they give the money. So that's a way of transferring money from the investor to the borrower. And borrower agreed that okay, after a certain time, which what we call it as an expiry of the bond, I will return the principal amount, as well as over this period of time I will pay interest on it. So interest rate is determined by the price of the bond, that how much in actual they are paying. So there is a one rate which is written on the bond, that is a fixed rate. But if the price of the bond is less or more than the face value, then it determines the real interest rate the investor is getting from that bond. So what is a bond? So bond is a debt instrument. In a definition, in a textbook definition, we define it as a debt instrument. Means that instrument we use to create to get debt. Borrowers promises future payments, like payments of interest, as well as the payment of the principal back to the investor. The governments and corporations are the main issuers of these bonds, because unknown individual or unknown firms cannot do this because the public don't have a trust on it. So the government, the people have a trust on the government, so they buy the government bonds. Those large corporations, they have a reputation in the market, so people buy their bonds. But if it is it's only these corporations which are having a reputation in the market, so they can sell the bonds. Investors earn interest income. So the income that we generate on the bond is called as interest income. So it's slightly different than the it's a different than the stocks, because stocks on the stock the incomes are called as a dividend. So that's a different than bond. Now, if we talk about the key features of a bond, so these are 4 key features of the bond. Is there is a face value, that's what is written on that bond contract. Like normally in Canada we issue a bond of a $1,000, so it's a 1,000. Like a you have a paper bill, currency bill in your pocket. So it's one is $5, the other one is $10, the other one is $20. Why they are different, 5, 10, and 20? Because what is written on it is the value of that. So the same is the case with the bond. If it is written as a 1,000, so it's a $1,000 bond. If it is written as 100, so it's a $100 bond. So 1,000 face value of the bond. Then the second thing written on this bond, or is in that agreement, is coupon rate, the rate of interest that the borrower is going to pay on it to the investor or to the buyer of the bond, the rate at which they're going to pay, like a 5%, 4%, 3%, whatever, that is fixed. So every and the term of the payment is also fixed, like a quarterly, half yearly, or annually. So they're going to pay like this. So if it is a, for example, if it is a $1,000 bond and the coupon rate is 10%, so the bond issuer is going to pay $100 each year. And if it is an expiry of a 5 years, so after 5 years, for the 5 years, each year the bond issuer is going to pay 100, 100, 100, 100, and at the end of the 5th year is going to return this 1,000 as well. The investor is going to get 100 each year as an interest income, and at the end he's going to get back his 1,000, which is the face value. So you understand the difference between face value and the coupon rate. Why there is a coupon rate? Because in olden days, bonds were issued on a paper, and papers are attached with this bonds are certain coupons. So each time, whenever they get the interest, so they have to return the one single coupon and then get it the interest. So that's why we define it as a coupon rate. There is a maturity date, as I mentioned earlier in my example, that the bond, if the bond has a for 5 years, so this maturity is 5 years. It can be 10 years, it can be 15, 20, 25, 30. So mostly the longest period that bonds issued are of 30 years. So that's different maturity dates. But it's mentioned on the board bond each time when they are issuing that this is the maturity date for us, like a 5-year, 10-year, 20-year, whatever it is. So they decide it and they make it very clear to the bond or the investors in the bond that this is the maturity date for this bond. But definitely it doesn't mean that the investor is going to stay till the maturity, so they can sell it within that period as well. But that in that case they have to go to the secondary market, and that's why we mentioned that the bond market should be active. So if the bond market is very active, so the investor or the bond holder can easily go there and they can sell. And when they sell it, so it's all depend on the price, and current price can be different than the face value. So we will see this. Now this yield, now how much the investor is earning, it all depends on the market interest rate, and market interest rate defines the price of the bond. And also so one is a coupon rate. Coupon rate is a fixed interest rate which is mentioned when they are issuing the bond, but the yield is the difference, because the price is different when they are buying and selling. So for example, when they are selling, the price is more than 1,000, so they're going to earn more. The amount over the 1,000 plus the interest they earned before, so that's a yield. And sometimes we also define it like the market interest rate is going to define it as a yield. Who are the major players in the bond market? Governments, corporations, households, pension funds, banks, and financial institutions. So we already discussed that these are the way that they can. Now, the uniqueness in the bond market is that when the interest rate change, and you know that Bank of Canada announced the benchmark interest rate in their monetary policy statement. When they change it, so that is going to be the benchmark rate, and based on that benchmark, all other rates change. Now, when the rates change, that has an impact on the price of the bonds. Why? Because, for example, we are talking about a bond of a $1,000 issued for 10 years with a 10% interest rate. So it means that the bondholder is going to get it every year $100 as an interest income. If the interest rate in the market is 15%, so the bondholder is losing money in the way that he is getting only 10%, but if he invests in any other market instrument, so maybe the rate is going to be 15%. So in that case, the value of this bond is less than the face value, because face value is 1,000. Face values are always what is written on it, but the market value is less. Why? Because the interest the bond is earning is less than the market interest rate. But if the interest rate is less than 10% in the market, for example, it is 8%, So then this bond has a more value because the bond holder is earning 10% and the other market instruments are only offering 8%. So this 2% over the market rate creates a more value to the bond. So probably the bond has a more value than the 1000, and that's the way. And that's why we can say that the bond prices and interest rates moves in opposite direction. Like if the interest rates increase, bond prices decrease, and if the interest rate decrease, bonds prices increase, and if the interest rate increase, bond prices decrease. So this is the way that it works. So when bond prices rise, the fixed payment becomes less attractive. That's what I mentioned, that the coupon rate is fixed. So relative to the price paid, lowering the yield. So that's why the inverse relationship exists. And this is the reason that the inverse relationship exists. So here is an example, like we just as I mentioned. So face value is 1000 and annual payment of coupon rate is 100. So it means it's a 10%. And if the market interest rate is 10%, so it means that the face value and the market price of the bond is going to be same. This is what we call it as a par, at par. So they are at par, like a face value and the market price of the bond is equal. But if the interest rate, or we can say that if, let's assume that the market price of the bond is 1100. Now, in that case, it means that this bond is more valuable than the face value. Like a face value is 1000, but in the market, the people are buying and selling this bond, this particular bond with a 1100. It means that the interest rate in the market is less and the yield is, yes, that's a less. And how much it's less is, so there is a one formula which I can explain here. That's what we calculated. Interest rate, or we can say it's a yield. What is the formula? Face value minus price divided by price into 100. So by this way you can calculate the yield. So if you subtract 1000, so I can make it here 1000 minus 1100 divided by 1100 into 100, so we will get 9.1%, which is this. So I just applied. Now if we take this example, so in this case what is happening is that it's a 1000 face value minus 900 divided by 900 into 100, so we get it like 11.1%. So you see, when the price is more than the face value, so the yield is less than the coupon rate, and when the price is less than the face value, the yield is more than the coupon rate. So I hope you can understand this way. Now, why there is a demand in an economy for bonds? So demand increase when wealth increases. So if the wealth is increasing in the economy, so people need to invest because of this more wealth or extra wealth. So bond market is one of the avenue where they can invest. Risk falls. So if the bond market is very active and the risk of default and the risks that we cannot liquidate it quickly, if that all these risks, risk of liquidity, risk of default, and all these risks go down, so the people feel it more confident to invest in bonds. So the demand for bonds will increase. Expected returns rise. Like if the returns on the bonds are increasing, like the yield is more, so definitely the investor is going to invest in it. And alternative returns falls, like other assets where you can invest. If those the returns on those assets are decreasing, then the investor is preferred to invest in bonds. So these are the reasons that can create a demand for bonds. Supply is mostly is generated by if the firms are want to expand, so they borrow more. Governments run deficit budgets, so they borrow. So you know that the government finance their deficit by borrowing. So that's the way that they can borrow more by selling bonds. Investment opportunities expand, like the economy is growing, and when the economies are growing, so there is a lot of opportunities that the new businesses can invest there, and by this way they can need money to borrow, and the bond market is a one way of generating funds for these opportunities. Now, as we see that bond market is having a demand and as well as supply, so definitely the price of the bond is determined by the interaction of demand and supply. And here we see that this D1 is the demand curve for bonds, and this S1 is a demand curve for supply curve for bonds. So with the interaction of these two, supply and demand, we see that this is our equilibrium of this market. Now this equilibrium reflects that this Q1 quantity of bonds are going to purchase and bought and sold in this market. And what is the price? The price is 950. So it's a $1,000 bond, but at this moment, because of the demand and supply interaction, the price is 950. Now, because of any reason, what we discussed before, the supply increases and supply curve shift to the S2. Now, when the S2, the supply curve shifts to the right, it means that there's an increase in the supply of bonds. So because of this, for example, the government has a large deficit in their budget, so they finance it through by selling bonds. So the supply of bonds increase, and by this increase in supply, our new equilibrium. This is our new equilibrium. Right? This new equilibrium is at the price of 900. So we move from 950 to 900. But as we already mentioned, that when the price of a bonds decreases, interest rate increases. And how it is increases, again, if you apply the formula, what we discussed in our previous slide, 1000 face value minus the price, which is 950 divided by 950 into 100. So if you calculate it, you get it 5.3%. But when the supply increases and the price went down to 900, so if you calculate it based on 900, it's 11.1%. So by this way, we see that the price of the bond is decreasing from 950 to 900, but the interest rate is increasing from 5.3% to 11.1%. So interest rate and investment. Higher interest rate increase borrowing cost, and firms reduce investment spending. So when the interest rate increases, what happens? The firm's investment, I of a real GDP, decreases. So if you see that the aggregate demand, which we discuss in, so aggregate demand or output is C plus I plus G plus NX, which is net export. So when the interest rate increases, borrowing increases the borrowing cost, and with the borrowing cost, what happens that this I go down. So when the I go down, this aggregate demand also go down. So that's an aggregate demand falls. If we do the opposite of it, like a lower interest rate, so lower interest rate increase the investment spending, and aggregate demand increases. So here we see that the bond market and macroeconomic performance. So in panel 1, what we reflected here is that we have a bond market, and there's a demand curve for bond market D1, like this one, if you look at it, and there's a S1. So that's our demand. So an increase in the demand for bond shift the demand curve to D2. So that's a D2. So price of the bonds increase from P1B. B reflects the bond. So P1B is a bond price. It's not a price level. It's not a general price level. So it's just a price of the bonds. So P1B increases to P2B. And as we know that when the price increases, what happens? Interest decreases. So in the panel B, what we reflected is that because of this decrease in interest rate, investment increase and our AD curve shifts to the right. So AD curve shifts. And with this AD curve shift to the right, what is happening? That the real GDP increases from Y1 to Y2 and the general price level increases from P1 to P2. Now in panel C, again, this is a bond market, and here we have a D1 and S1. And in this case, what we are reflecting that the supply of the bonds increases. Now, supply of the bond increases, shift the S curve S1 to S2. This one, there is a shift. And this shift is reducing the price from P1B to P2B. And we know that when the price of the bonds decreases, it means that the interest is increasing, and that is going to shift our AD curve to the left because the I is reducing, investment is reducing. And we see that the real GDP go down from Y1 to Y2, and the price level also decrease from P1 to P2. So that's a way that we relate it with the bond market with the real GDP or the macroeconomic performance by calculating aggregate demand. So this is our first market. We want to talk about it, and we showed you here the relationship between the bond market and the real GDP change or real output change.